Okay, before we head in for this week's market outlook, just a reminder, 6 o'clock tonight, April 9th, 2023, that's today, 6 o'clock tonight, I have a live information session for any level 2 candidate, any candidate that will be entering level 2, or any level 1 candidate who will eventually be going to level 2. You may have some questions or may want to listen in. That starts at 6 o'clock tonight. Usually when I do these, they go 3.5 hours because I just stay on for as long as there are questions. If you are looking for any of the CFA products that we offer, just go to markmeldrum.com. Mark Meldrum is one word, markmeldrum.com, and you'll find everything there, along with the applied series as well. Also, next Sunday at 6 p.m., when the market opens, I'm going to do the first live Q&A for the market outlook. So for all of you that watch this every week, next Sunday I will do a live feed at 6. And you can ask me whatever questions you want, if it was on the market outlook or other questions. We'll start at 6 because that's when Globex opens and we get our first look at how the market feels about things. Although I'll be honest with you, you could have Globex open up 30 points down, and by the time you wake up Monday morning and the Americans show up, you're up 60 points. Like, it used to mean something. Now it doesn't mean very much. Anyways, let's head on in. Let's see what we have. Well, some interesting things over the last week. From the time I posted the market outlook last Sunday, a little while later, OPEC did a cut, and oil prices spiked. Energy prices are higher, which is going to work against what the Fed wants to do. It's holding around $80 a barrel. We'll have a look at where that is and what the curve looks like, the futures curve looks like there. Maybe it's got some information for us. Also had 2 ISM reports for the week, manufacturing and non-manufacturing. Neither one of them were a positive for markets. And then we had a jobs report on Friday. And if you were watching the futures Friday morning, futures thought that was positive. So that if SPX, the actual index, was trading that morning, SPX would have shown a small gain week over week instead of a slight loss week over week. So let's see where we are here. The 1 month down 18 basis points, 4.56. That's below the Fed funds range of 4.75 to 5. So you've got an inversion from the target rate to the 1 month right out of the gate. However, the reverse repo facility is down significantly. So perhaps it was less reliance on the reverse repo facility and more money found a home in the 1 month, which drove up the price, which drove down the yield. The 2 month out to the 6 month have all increased, and they're well within the range, 4.75 to 5. We can see that. This 4 month here is reflecting the possibility that you're going, some probability that you might get a May 25 basis point hike. All capital market rates have given back. The 2-year all the way out to the 30-year have lowered again. Look at the 10-year, basically from the beginning of the year, having cut rates 50 basis points at the 10-year. In fact, you got a 50 basis point rate cut pretty much consistently across the board, 44, 50, 50, 51, 49, 41, right across the board. The Fed has increased rates twice. The market has cut rates twice, 100 basis point difference between them. So if we go back to the 4.25, and say, well, you know, if you think about balance sheet runoff, because we have it down here, another 50 billion, so we're down to 7.72 trillion, and it breaks down to treasuries and T-bills this way. If you think of balance sheet runoff as being, well, maybe equivalent, because we've heard this equivalency before, maybe equivalent to 25 or 50 basis points of tightening, because it is a form of tightening. It is withdrawing money from the system with them not rolling it over. Somebody else has to step in and fill the gap when they don't roll over their investment in security. Somebody else has to take their money and buy these instead. That maybe, 4.25, if you saw a 10-year at 4, That's equivalent to 4.25 without balance sheet runoff. You could say that, and you could say the tighter lending standards in the banking system, which probably will result from the banking troubles we saw a little while ago. I don't know if you remember, a couple weeks ago there were a couple of banks that failed. I know the equity markets can't remember it. I don't know if you remember it, but it was a big deal. People are still talking about it. You still hear the acronym SVB. That was a bank that failed. Again, I'm being very clear that equity markets don't remember it, so I'm hoping you remember it. But if we think about tightening credit standards, which Powell in the press conference says he naturally expects that to happen, maybe that's equivalent to 25 to 50 basis points. If you take 25 to 50 off the 4, you get to 3.5 to 3.75. That if a 10-year were sitting there, considering the tightened credit standards in the banking system, considering the bank runoff, you'd be at 4.25. Well, 3.39 is just under the 3.5. Perhaps the market is just doing some math that way and saying, listen, yields don't have to do all the heavy lifting. Balance sheet runoff is doing some of it. A natural credit tightening in the bank system, well, that's what we wanted anyways. So we don't necessarily need a 10-year at 4.25. If the banks are going to do some of the heavy lifting for us, we can live with a yield of 3.39. Perhaps the long end of the curve is simply just reflecting the extra help that the target rate is getting, rather than rates doing all of the work. It might be reflecting the extra work being done in other parts of the system to help bring inflation down. And if the belief is, well, it's equivalent to a 10-year at 4.5, that would push inflation down. Well, then a 3.39 would be consistent with a lower expected inflation going forward. So that we could apply a different interpretation to the long end of the curve, that it is not reflecting rate cuts by the Fed. It is just saying these yields don't need to do all the work. There are other things that are doing work, and this is good enough. And if you're looking for a bullish argument on the long end of the curve, that could be it. It could be nothing more than the market saying, yeah, we got help now. We got partners in the fight with us. We're not the only ones on the front line. Could be. I don't know. ISM data doesn't suggest that. Leading economic indicators are not suggesting that either. Neither is the yield inversions in the money market, the capital market, suggesting that. So look at our curve inversion, the 2 to the 10, 277 days now. I think early July last year, it inverted. So we're about 3 months out, 90 days. So if you put 90 days on that, you get to a year. It hit a record of 107 on March the 8th. We're only 1 month later, and we're half of it is gone, negative 58. However, the 3 month to the 10-year, 165 days now. This is the deepest we've seen, 156. In fact, the day before on the 6th, it was 161. The jobs report helped out a bit on this one. 161, this is a record on Thursday. That was a record for this inversion. Also a record for this inversion. Not a record overall, but a record for this inversion. You got to get above 200. To break the early 80s, and then from there, I don't know if there's anything deeper, but we're at a 43 year low on the inversion. I don't want to say high, but if we take the absolute value of it, the inversion is at a 43 year high, meaning negative 156 in an absolute sense. The 3 month forward, 18 months from now minus the current 3 month, negative 203 basis points versus 172 last week. And I'm using 3 month SOFR to get that done. This is what the Fed watches, is the inversion in a current money market rate with a forward money market rate, suggesting that over the next year and a half, you've got 200 basis points of cuts coming in at 25 basis point each meeting. That's 8 cuts coming in over the next 18 months, suggesting basically that they've pretty much got to start, cutting in the next, 2-3 quarters. They got to start cutting. At least that's what that inversion is saying. So we'll see how that plays out. The Fed balance sheet. This is just the SOMA that we look at down here. This is just the securities that were bought, particularly for QE, that are running off. The Fed does have its own balance sheet outside of what it bought for QE. 8.6 trillion. Last week was 8.7 trillion. Is down 73 trillion dollars. Keep in mind, 50 billion of that was the SOMA. So banks have reduced their reliance on the Fed by another 24 billion. The flow into money market assets is not stopping. Increased another 49. This is as of April 6th, right? Increased another 49 billion. 5.25 trillion for the week. Retail up almost 22 billion. Institutions up 27 billion. And I think this is interesting. I think primarily this money is not coming from the equity market. I don't think it's coming from the bond market, because yields are going up, which means prices are going up, so money's going into capital markets. I think this is coming from bank deposits. I think what the bank failures did a couple weeks ago, you remember those bank failures, right? What those bank failures did a couple of weeks, because it was so well covered, almost everywhere it was covered, and quickly, is I think it highlighted to a bunch of depositors that there is a limit to insurance, and you're not getting paid to keep your money in the bank. That why not move your money into money market funds? You're not getting paid to leave it in your account, and if you have anything over 250, why don't you sweep it out of there and put it in money market funds? Because this is continuing on, 5.25 trillion. Well, think about the returns you're getting. Some banks aren't even paying anything. They're not paying anything. I know I have commercial deposits, and my commercial deposits exceed the 250. And I don't know why I'm not. Every day I think I should move it out of there into IB and buy some 1 month or 2 month US Treasuries. But I keep delaying, and I keep thinking about it after the market goes, I forgot to do that today. But I don't think that I'm the only one thinking of moving it out, and that it just could be that that crisis highlighted to everyone an alternative they always had, but they never really thought about it. Now they're saying, hey, that is an alternative. I never really thought about that, because for 15 years it just wasn't an alternative. Like from 2009, 2010, 15, 16, 18, 19, 20, 21. It just wasn't an alternative, so you become trained just not to think that it's an alternative, but now it is, and you have to keep reminding yourself, it is an actual alternative. So this could, this idea of 5.25 trillion, I hear it referred to as money on the sidelines. That's why this equity market could rip higher, because there's a lot of money on the sidelines. By the way, if you've ever listened to anybody explaining why the market can go higher, of all the bullet points they list, money on the sidelines is always one of them. Always. Yet, there's a certain amount of money that lives in the money market no matter what's going on. There's just a certain amount that lives there no matter what. And you have to think about, where did the money come from when it went into the money market? I don't think it's coming out of equities, and I don't think it's coming out of the bond market. So when it does come out of the money market, it's going to go right back to where it was before. I don't think it's moving from the equity market into money market. So I don't think that this money on the sideline belongs to the equity market as much as equity bulls would like to think that it belongs to them. Big week this week, especially Wednesday. Not much is happening Monday and Tuesday, other than whatever narration happens to be ruling the day. But Wednesday, big things happen. Next FOMC meeting is 24 days away. On Wednesday at 8:30, we're going to get March CPI. That is going to be a big number. Hour and a half later, you get the Bank of Canada rate decision. An hour after that, you get the Bank of Canada press conference. 3 hours after that, the minutes from the March FOMC drop at 2. So from a Canadian perspective, playing the U.S. markets, Wednesday is a nothing else but the market day. just absorbing everything and thinking about where you want to be. And just when you get positioned after the CPI, Bank of Canada will hit you. Then the minutes will hit you. And then you got earnings to think about. Earnings start next week as well. JP Morgan being the big notable among them. I am going to be listening to most of the conferences. I'm especially interested in their loan loss provisions and what that's going to look like going forward. 25 basis points for May has a weighting of 71.2, up from 48.8. That brings zero less likely, under 30% probability. And if you go out to June, peak rate of 5.25, which is consistent with a hike in May and no hike in June, 70%. There is no 5.5. Next week, if CPI is higher than it should be, so it does not moderate but actually increases, I think you could see a 5.5 show up here again, meaning a 25. Most of the weight would end up here, and there'd be a 25% probability for another 25 basis points. Sorry, there'd be some probability for another 25 basis points in June. That's if CPI comes in hotter than expected. But you also have PCE at the end of the month. You're not going to get another jobs report. Those are the two big ones. And I think we get the ECI at the end of April. That's the Employment Cost Index. That matters more for measuring wage inflation than average hourly earnings does. But right now, the thinking in the market is we are done with this rate hiking cycle, or at most there is one more and we are done with this rate hiking cycle, which means this is the worst of it in terms of where rates can go. This is the worst of it. It can only either stay this way or get better. Well, getting better, we're going to see what Williams says down here, and we're going to ask how much better could it get. Effective federal funds rate 4.83%. That's right in the range of 4.75 to 5. Reverse repo fell 201 billion, still elevated over 2 trillion though. It's been over 2 trillion post-pandemic for some time now. That's going out at 4.8%. You do have some Fed speak this week. You have 4. Monday is Williams. He's with the New York Fed. He is a voting member. He is the vice chair. On rate rises over, this is from Friday, and I expect him just to repeat the same speech from Friday. I don't think there'll be anything that has changed significantly over the weekend. On rate rises over the last year, Williams said after his speech that so far, mostly what we've done is bring interest rates back to a more normal, slightly restrictive stance. Two things I want to point out here. Slightly restrictive. He looks at where they are, 4.75 to 5, and doesn't call it restrictive, doesn't call it sufficiently restrictive, calls it slightly restrictive, so that if there was upside, he'd vote for it. So I think he is at 25. I don't think it would take much to get him to 25 because he thinks that it is slightly restrictive now. The more important part is it's more normal. He doesn't see this as being abnormal or a deviation from normality. He sees we bring interest rates back to a more normal, slightly restrictive stance. So if this is slightly restrictive from 4.75 to 5, what does he think is normal? Right? Because you have 0 to, let's say, 10%, and you have something you'd call normal. And we're at 4.75 to 5, and he's calling that slightly restrictive. I'm sure 10% he'd call massively restrictive, and 0 he'd call massively accommodative. Well, if 4.75 to 5 is slightly restrictive, what does he think normal is? 4? And if that is the case, and you look at the forward curve for 3 months SOFR, it's doing this. If we go with more normal, perhaps the forward curve should look more like this. That if rates are being cut, the forward curve is going into less normal, more accommodative than what he thinks it would be. I just find it interesting that he's referring to the level of these rates as a more normal, slightly restrictive stance, but I do expect him to repeat pretty much the same thing. I don't think this is going to be market moving. Tuesday is Harker. He's with the Philly Fed. He's a voting member. Then you have Kashkari, Minneapolis. He's a voting member as well. I am sure you remember him from the movie 300. He was Xerxes. If you put those two people side by side, Google Xerxes from 300, get a picture of him, get a picture of Neil Kashkari, put it side by side. Tell me those two are not the same people. I'm pretty sure that's who it is. His last talk was on March 31st on housing. He did answer some questions about policy, but his talk was mostly about housing and talking about pricing today being a supply shortage. And pointed to regulation that you just can't build where you want to build. Sure, there's plenty of land, but there's a lot of regulation protecting the river, protecting the view of the mountains, protecting this, protecting that. And he is suggesting that it is driven by people. And he gives a story of his own neighborhood saying, we have big lots in our neighborhood. And if somebody came in and said, well, there's this piece of land in here, let's build affordable housing in here. Well, to build affordable housing, you're talking about density. You're talking about lots of houses on the same size lot. And so instead of one big lot with one house on it, you'd have a big lot with 4 houses on it because you got to get density. Well, that would introduce an economic element into the neighborhood that these people don't want. That's his argument. He's saying that we have a certain amount of economic segregation. We are around economically similar people. He made a point of saying economically similar, not demographically similar, economically similar. We do not want in our neighborhood people of a lower economic level than we are. We bought our way into this neighborhood. That's how we want it. We want this economic segregation, and we're not unique. People everywhere want this. So yes, while there is plenty of land to build, the reality is that people who are in those neighborhoods don't want that going on in their neighborhoods, and that's why you have the supply shortage. You don't have a land shortage. You don't have an opportunity shortage. You just have a willing shortage. Even in California, which is very progressive, saying we need to do something. We need to build more affordable housing. But every time they find a piece of land for affordable housing, these neighbors all show up at that council meeting and saying, not in my backyard. Over there, those neighborhoods. Build them in those neighborhoods, not our neighborhoods. Liberals, progressives. Friday, you have Waller. He's on the board of governors. He's not associated with any of the banks themselves. He is a voting member. His speeches regarding the Phillips curve, what it looks like pre-pandemic, during the pandemic, post-pandemic, and how monetary policy or the effect of monetary policy, given what the shape of the Phillips curve, the effectiveness of monetary policy, given that. I expect he'll continue on with that. So I don't know that any of this is market moving. If anything, Kashkari seems to be the one that is more interested in crushing inflation. He was asked about 2%. Why not 3%? He was asked about that too, the 2%. And he says, well, we can't change it. There are some economists that are suggesting that 3% seems to be more valid. He says, but we can't change it until we get to 2% because we'll lose credibility. And I think that's the conversation in that room. So they're not going to change it. They're going to stay with the 2%. Maybe once they get to the 2%, they might change it to 3%. But we have to understand something here. The dual mandate of the Fed. One is full employment. One is price stability. Rates are the volatility of rates are level dependent. So if you look at interest rates, if you look at growth rates, if you look at anything that is a rate, the higher the rate, the higher the volatility happens to be. Unemployment is a good example of this. The lower the unemployment is, the lower the volatility in unemployment. The higher it is, the higher the volatility. So if you're going from 2% up to 3%, you will get a higher volatility of inflation. Well, if one of your mandates is price stability, by going to a higher rate and introducing more volatility, well, you're going to have to give up on your definition of what stability is. You're going to introduce volatility in your stability. Isn't that sort of an oxymoron? Or as some people call it, oxymoron. So yeah, pushing higher, you are going to have to say, look, our mandate for price stability is going to be less stable than it was before. We have to expect less stability in our price stability if we want higher levels, because that also comes with higher volatility. Thursday, after Bank of Canada on Wednesday, the rate decision press conference. Thursday, Tiff Macklem is speaking. Okay, for real rates and break-even rates, not much going on. These are small moves. Again, on the break-even rates, a result of just the movement between the nominal and the reals. I don't know that there was a lot of thinking in there in terms of, oh, these break-even rates are too high, too low. Those moves are just too small. Nothing to see here, folks. Let's have a look at Fed Fund futures. Last week, the index was bottoming in May at 95.06, implying a rate of 4.94. Now we're bottoming in June at 95, implying a rate of 6 basis points higher, and a 1 month a little further, suggesting a lean towards, yes, one more rate hike, or higher probability of one more rate hike. For December, 95.59 is now 95.55, a drop of, or an increase of 3.5 basis points on the implied rate. That's just, I think, wiggling in the market during the week, but I don't think any real information on direction. Call that unchanged. And if we go to March of 2024, 95.92, that's a rate of 4.18. There's definitely rate cuts priced in going into 2024. December 2024, December 2023, because this is December 2023 over here. So if we look at all of 2024, 1 month SOFR 2.77, December is 4.11, 134 basis points over 2024. So it looks like we're 4.75 to 5. This is 4.45, kind of a 50 basis point drop into the end of the year, followed by another 134 here, which is 184, which matches closely with the 200 that we saw on the first screen for the 3 month, 18 months from now, minus the current 3 month. So this is 134. Last week was 130. The week before 97. The week before 78. So it's the market is more and more leaning towards, yeah, there are going to be rate cuts. And again, if you listen to the Fed, if we take them at their word, unless something really bad happens in the economy, these rate cuts aren't going to happen. And if these rate cuts do happen, then equity markets are going to have to come to some sort of reckoning. They can't keep just looking past everything and ignoring everything. TLT during the week up 2.12%. SPY basically flat, but again, if you count Friday morning's futures and you apply that into the SPY, the market did eke out a small gain last week. Not much, but a small gain. Friday alone, the bond market was open, so Friday we did have some movement. From Thursday to Friday, the 10-year went up another 9 basis points. The 30-year went up another 7 basis points, because that jobs report does give the Fed permission to go 25 basis points. Implied volatility increasing. The 13-month is now, 13-week now at 62% versus 29, the 29th percentile. I did close my April 102 puts for 13 cents. I don't know why I'm crossing it out, for 13 cents. Remember, I bought them for 202. So with everything that I've worked off now, including the 115 that I sold against the 110 long, my minimum gain at this point is 17,340. So even if TLT doesn't get into the spread beyond 110, stays below 110 by January, I walk away with 17,340 anyways on that. I don't really know what to expect here. I don't think we're going to see anything exciting on TLT till Wednesday. The CPI will give this direction, and if we do get any drop here at all, I will sell puts for May. I don't know if I'll be able to sell the 104s for anything worth anything. If we have a drop maybe to 107, 106.50, I might be thinking about selling the 105s. But I'm not done selling puts yet. I don't want to sell them at 107. I'd rather wait and see if we can get some kind of pullback on TLT. If not, that's okay. I got a $5 spread, which to me is worth another 30 grand if we make the $5 spread. My worst case position is 17,340, so that's not a bad decision tree, right? Do nothing, and I get 17,340. If it makes the full spread, I get 47,340. So I gain no matter what happens. That's a beautiful position to be in. OAS for the week, almost nothing going on here, just calm. Looking at 6-month T-bill at 495, a 1-year at 461. The 1 to 3 year investment grade is 502. So moving away from a default risk-free to a somewhat risky bond. You add 41 basis points, but this is IG. It's fairly safe. Why not reach for the extra 41? It was 77 last week, so guess what? Some people are reaching for the 41 because that spread is decreased. This I find interesting. This is from Fidelity as of January 31st, though, 2023. This is a high yield interest coverage ratio. Look at this. So this is why, your high yield is still sitting under 500 basis points, which is the CDS, the fixed rate on a high yield CDS is 5%. This is sitting below that at 4.84 because interest coverage ratios are so strong. There's a lot of cash on corporate balance sheets, and it is being reflected in credit being, well, what are we worried about? Usually you're worried about a couple of things. You're worried about solvency and liquidity, and this is a liquidity measure, and there is no problem here with liquidity. And if there is no solvency issue, then we're good. This is from Palladius Capital Management, Manish Shah, a quote in a story that was directed to about commercial real estate, but he made this statement about private credit. Private credit doesn't have a duration mismatch with its liabilities and assets. Private credit isn't over-leveraged. In fact, it's barely levered compared to a regional bank, and there's a lot of it. This rise in private credit means in cases when you do have a recapitalization, private credit is there. So there's a lot of money in private credit. It's not that levered. There is no duration mismatch. This is not a regional bank, and it's there. So look, this was in response to Morgan Stanley suggesting that there could be up to 40% downside in commercial real estate, and that private credit might have some issues here. And his pushback is, well, hold on a second here. We're not a regional bank. Private credit doesn't have the same issues that a regional bank has. Another interesting interview, if you're interested in commercial real estate, was on Bloomberg. The CEO of Boston Properties was on Bloomberg. Talking about his company now. I think they're sitting somewhere in the mid-50s, down from 130. So they're down significantly. And he doesn't, he's not going to sit there and say, oh my God, this is the worst it's ever been. His story is that the spread between prime and off-prime properties is widening, and that's where you want to avoid is all the buildings that are not A's. Anything that is a B class building you want to avoid. Okay, on this screen I'm going to mix housing with commercial real estate, so I'll draw a line down here to separate the two. Let's deal with housing first. 30-year fixed rate mortgage from Freddie, 6.28%. That is of April 6th, down 4 basis points for the week. So if we compare that with the 10-year Treasury, Thursday over Thursday to end at the same date, U.S. Treasury is up 5 basis points, fixed rate mortgage down 4, so the spread decreased by 9 basis points. We know mortgage REITs are sensitive to the spread. A decrease in spread is a benefit for them. Agency up 2.79% for the week, annually up 0.31% for the week. Now, I find this odd. Mortgage applications down 4.1% after a nice 4-week run. It shows a negative. This is for the last week of March, and you had rates that were decreasing during that period of time. Both refis and purchases are down. Housing had kind of a rough week as well. DHI down 2%, Lennar almost 3%, Toll Brothers 4%, Pulte pushing 1% down, KB Homes 4%, and the XHB down 5.25%. So what am I doing with the mortgage REITs and with housing? I'm out of equity REITs, by the way. I'll talk about that when we get over here. But mortgage REITs I still like. So this is 10%, this is 20%, roughly about 10% or 20%. On the next expansion, the next business cycle expansion, I'm going to want a certain exposure in my portfolio. I want U.S. housing, I want mortgage REITs, and I want metals and mining. This here, the 10% means about 10% of my portfolio having exposure to mortgage REITs, and about 20% of my portfolio having exposure to the housing sector, U.S. housing sector, in whatever form I think makes sense. Not just the home builders, but suppliers to the home builders as well. I just haven't found any good targets yet, but those will come in time. What I'm going to do over the course of this year, because I expect weakness this year, I don't think that either one of these two sectors are going to break out to new highs anytime soon. I do expect some weakness this year and a recession. Yeah, the ISMs, the leading indicators, are all pointing in that direction. Leading indicators has a perfect record. The curve inversions, some of the curve inversions have a perfect record. Well, I'm going with that. But I still want to start accumulating positions. I already have some shares, but nowhere near enough. I'm nowhere near 10%, nowhere near 20%. So I'm going to sell puts on these on any weakness. I'll be looking to sell puts at 30 delta. So if there's more weakness on DHI, if I see it push down to the low 90s, I will look for a 30 delta put, and I will sell 30 delta puts 30 to 45 days out, depending on, how far, if the next expiration is 17 days away and the one after that is 48 days away, I'll take the 48. And this is my accumulation phase, is I'm hoping to buy on this weakness. You're never going to find the exact bottom, but if you have a good long-term view on the housing sector, buying the home builders, especially the strong home builders, the two big guys here, DHI and Lennar, are pretty much are the kings in the market in terms of size, and size matters. Economies of scale matter in this industry, and they have it. Accumulating on the way down makes a lot of sense. You don't want to buy a stock on the way down if it's going down for its own reasons, but if it's weak because the economy is weak, if it's a strong performer in a weak economy, then dollar cost averaging on the way down is reasonable. I hope to build at least a 20% position in the housing sector and 10% in the mortgage REIT sector for the next expansion. And for metals and mining, probably another 20% there as well. Let's move over to commercial real estate and, by association, all equity REITs. I am out of all my REITs at this point. You're starting to see dividend cuts coming in, especially in the office REIT sector. Slate Office REIT in Canada cut its dividend last week, and it lost 33% of its stock price overnight. So, and I saw that on the screen. I was very happy that I had gotten out. In fact, I looked at all the prices of everything I sold, all the apartment REITs, I had some retail REITs, office REITs. I got rid of everything. Looked at the price, they were all lower than where I sold, which is a good feeling. When you sell something that's, you got a little bit of a loss on it, you sell it only to see it go higher in the future. You hate yourself for it. But when you sell something at a loss, it feels bad. But when you look 2 weeks later and the price is even lower, it's a win. You get the same dopamine rush as actually getting a gain on something, because you think, I'm winning, because you're not losing anymore. Because if you held, you'd be down even more. So right away, on a relative basis, you've won. So I looked at all the prices of everything I sold. They're all lower. And that was a good feeling. I took a loss on the equity REITs that I sold, but you will remember over the months I was selling calls on IYR. as a proxy for risk management on my REIT portfolio, because each of the REITs I held, some of them didn't have options, some that did just had illiquid options, so you couldn't get anything done on a name-by-name basis. So I was using the IYR as a proxy against my REIT portfolio. I was selling calls here, and I did quite well selling all of these calls. I never lost on the calls. Always made a gain on all of the calls. So that offset the loss that I had to take. And just seeing them all lower was it just felt good. It was like, okay, I made the right decision. The last thing you want to do is sell something and then just watch it take off. I've done that before, and that just sucks. Let's look at what's going on in commercial real estate. This is Morgan Stanley's statements up here. This is a response to Morgan Stanley's statements, and this comes from CBRE down here. Up to 40%. Price depreciation or price drop from peak to trough in commercial real estate. This doesn't say 40%, up to 40%. So it has this range and it has a number of scenarios, and so you could see up to 40%. Points to this stat here: more than 50% of the 1.9 trillion in commercial real estate mortgage debt is due in the next 24 months. And if we are going into if rates are going to be higher for longer, that over the next 24 months, that's going to have to renew at higher rates. And if we are going into a recession, credit is going to dry up, and especially for commercial real estate, especially for office commercial real estate. And that's what they're pointing to, that you could have a lot of selling that has to happen because the buildings will then go to the creditors, and the creditors will then have to reorganize or sell or try to find some money somewhere. And if credit is tight at banks, private credit's going to be more expensive, regardless of what was said on the previous screen, that there's a lot of private credit, that it doesn't have a duration mismatch, it's not over leveraged, it's still going to come with the cost. So just that alone, I don't think you want to be anywhere near commercial real estate. And even if you see, Boston Properties is in the mid-50s, you might think, well, that's a good place to enter. I still wouldn't enter there. I wouldn't be lured into it. I would just stay away from equity REITs altogether until the dust is settled and it's cleared. Doesn't matter if you miss the first 10 or 15% of a rebound. Let it happen first. Let the numbers show up. Let's be certain that it's okay before you go back in, but I would not try to catch this one. In fact, IYR sitting at low 80s, I would not be interested in looking at this till it got to the mid-50s, the low 50s, even the high 40s. Boston Properties in the mid-50s, maybe the mid-30s. It could, and that's why I just don't want to be anywhere near it. This is a pushback on the Morgan Stanley report. It comes from a story, and the link is in the description box. It's a story with the title, "Private CRE Lenders Forecast Partly Cloudy Future as Morgan Stanley Warns of Hail." Partly cloudy future. And this is from, I thought this was a pretty interesting paragraph from that story. "Supply will moderate as developers hit pause," so that that will act as a shock absorber in itself. High availabilities will keep developers and construction lenders on the sidelines in 2023. Less than 38 million square feet is slated for delivery in 2023, down 27% from the 5-year average. A thinning construction pipeline will reduce supply-side risks over the next few years, likely resulting in, an interesting word here, an acute shortage of prime office space. Notice they're saying prime, not secondary, but prime office space in the long term. However, as underway projects deliver and occupiers try to sublease underutilized space, supply will eclipse demand, pressuring rents in 2023. That is why you should just stay away from commercial real estate altogether, from all equity REITs for now. Because you do have this supply that is still going to hit the market right when you have some tenants who just want to get out. And then you're going to have this underbuilding, which is exactly what happened in housing in 2008, 2009, 2010. You had this massive underbuilding in housing while everything was worked off, and look where we are now with this housing shortage. But that is still years in the making. There will be another day for equity REITs but I think it's done. They had a good 10-year run from 2010 to 2020, a beautiful 10-year run. I mean, I was almost entirely in REITs for those years. It was beautiful. But you have to know when to walk away from something, and we're going to walk away from this. Maybe come back in a couple more years and have a look, but right now I'm just not interested in this space. Look at this down here. Class A, I'm saying wait. Class B, just avoid. Any Class B buildings, avoid Class A. You can wait. Dividend cuts are going to continue, especially in the office REIT space. So if you have office REITs for the dividend, you might want to rethink being there. This is office supply and demand, and you have a couple of things going on. The light green, the bars over here, is the absorption. What is absorption? It is the square foot that is leased per year minus the square feet that are lost per year. So if more, if you have 1 million square feet that's leased, and over the course of the year you then have 1.2 million, you have 200,000 square feet of absorption, positive absorption. You can see during the pandemic what was going on here, and it peaked up and now is basically disappearing at the far end down here. This is Q3 2022. The black is completions. You still see that there's still supply coming onto the market here, and the dots are vacancy rates. Look at this. And the vacancy rate is over here 11%, 12%. It's not like it's -30, -40. Vacancy rates here 11%, Q1 2020, and then look at that. You're pushing up to 17%. It's almost a 20-year high if you go back in time and look at the vacancy rates. So you have vacancy rates that are massively increasing, absorption rates that are turning negative while supply is still coming on. Doesn't surprise you that dividend cuts will continue if rents are being pressured. If vacancy rates are increasing, well, the rent isn't there to pay out those dividends. And if you have to think about, well, what cost am I going to have to roll over my debt? And if more than 50% of it is due in the next 24 months, this is where you do not want to be. Now, if you go to Bloomberg and you search for the video for Boston Properties, the CEO of Boston Properties, about a 6-minute long video. He's making the case that Class A, is having some trouble right now, but Class A is going to be just fine. It is Class B that you want to avoid because rents are coming down. Vacancy rates are going up and rents are coming down, but it is giving some companies the opportunity of being in a Class A property where otherwise they couldn't be. So even though we're losing some of our tenants, we're gaining some from a Class B up to a Class A that have always wanted to be in these buildings but couldn't previously afford to be there. But Class B has got a big problem. I would just avoid those altogether. And Class A, again, wait. Last week was a week for labor reports. Tuesday, JOLTS, mixed. If we look at job openings, came in at 9.93 million, under that psychological 10 million number, which had been elevated above for some time. And January was revised down, still over 10 million, but revised down to 10.563 million. However, the quits rate went right back up. We saw in January it dropped below that psychological 4 million number to 3.878, thinking, well, the job market's got to be getting a little bit looser. There's got to be some slack showing up because people aren't as willing to quit. In February, that number went right back up. We're back over 4 million. So in January, openings were over 10 million, but quits were under the psychological number of 4 million. For February, it reversed. Quits went right back up over that number, but now openings are under the psychological number of 10. I don't know that there's much there. Then we had initial claims, and there was a big deal made about, hey, the labor market is not as strong as we thought it was, but I'm there again. 228 were the claims. And if we look at the prior weeks, this was as reported, 198, 191, 192, 212. Strong market, right? Well, it was after the seasonal adjustment, it's now 246, 247, 230, 245. So increase of 48, 56, 38, 33 over the numbers we initially got. Well, let's go back, and this is a nice chart here. This is all the way back to July of 2021. Let's pay attention to the darker brown line. This is new claims after the seasonal factors. So this is new claims after. So over this period of time, we learned that, oh no, the job market was actually stronger than we thought it was. Then over this period of time, oh no, the job market's actually weaker than we thought it was. And here's like, no, the job market is stronger than we thought it was. Same here, the job market is stronger than what we thought it was. No, the job market is weaker than we thought it was. So it's like, it's not as if it were consistently a different story, where we look at the seasonal adjustments and we say, because of the pandemic, once you put the seasonal adjustments in, it shows that the job market was not as strong as we thought it was consistently. But it was stronger, then it wasn't. Then it was stronger, then it wasn't. I don't know. I'm not that impressed with it. Overall, I would say, okay, well, we're just happening to look in a period where it was oscillating between, no, it was stronger, no, it was weaker, no, it was stronger, no, we're just in that period. Had we done the adjustment at a different period of time, it would have been, hey, the job market is stronger than we thought it was. So I don't know that there's a lot of information to read in that, other than, that's where I am. It doesn't match the jobs report. If we look at whether we're looking at the household survey, a gain of 577. The establishment survey shows a gain of 236. And the gains are fantastic, really, when we look at where they're coming from. Self-employment dropped by 280. Part-time, which is the number of full-time equivalent jobs, part-time decreased by 342. Full-time increased by 1.1 million. So if you net these out of this, you get very close to the household survey. Look at that. Part-time jobs, which are lower paying jobs, self-employment, which is precarious employment, really, and full-time increasing. And I think the self-employment is decreasing only because supply chains are improving and it's easier to get a job in this economy. If we look at the home improvement sector for the last couple of years, it was just hard to find somebody to come out to do any kind of work. Well, that probably encouraged a lot of people to say, hey, I don't need to get a job. I'll be my own boss. Because nobody can get anything done, but I can do it. I can build this. I can do that. Well, now that supply chains are improving, these independents have now got to compete with those companies, those contractors in their city that have been doing it for years, that have reputations, advertising, word of mouth, and finding it easier just to say, okay, well, I gave it my best shot. But now I have to compete for the job, where I didn't have to. I could just walk in and get these big wages. Now I have to compete. I'll just take a job. Self-employment down 280. Part-time 342. Look at that. That is fairly strong. Less than high school, up 133. If you had a high school education, you weren't so lucky. You were a little too smart there. Negative 328. More than high school, but less than college, 81,000, and BA college or more, up 497. This is, compelling. Average hourly earnings up 3.31% on an annualized basis. So if you just take the average hourly earnings right here, I'm circling them in blue. If you take that and annualize the difference, you get to 3.31. And the Fed is anywhere between 3 and 3.5%. on employment cost from the ECI. Okay, let's keep in mind the ECI. This is average hourly earnings, which is a mix of the type of job, the sector that the job is in, and the wage that you're getting. If we look at the jobs report, we see in the goods producing side, there were job losses. In the services side, there were gains, primarily in education, healthcare, and hospitality and leisure. That's where all the big gains came from. Still 3.31% annualized, year over year, 4.24. If we're looking for wage pressure, if we take anything from this, we could say, given that it's full-time, which tends to pay more per hour than an equivalent part-time hour of work, given that higher education pays more than lower education, this is promising, 3.31. I don't think you can look at that and say, oh, well, there's an issue there. But you still have strong gains. And when you look at full-time, 1.1 million. Which means even with rates where they are, doesn't seem to be affecting housing stocks, doesn't seem to be affecting the employment picture. Jobs are still being created. Maybe we can go another 25 for good measure on our fight against inflation. Maybe we can. Economy is strong. We got two mandates, full employment and price stability, and full employment is checked. Why not go another 25? You could say that. This is a column is for March 22. This is January 23, February 23, March 23. 3.347 is now 34.4. January is 34.6, now 34.5, now 34.4. So if we look at what they're taking home, it's just slightly less. So the average hourly earnings are coming into a zone that looks okay. But if we look at aggregate incomes, the spending ability kind of dropping just a little bit, but dropping. The diffusion index, we haven't paid too much attention to this, but this is worth looking at here because I do think that this allows the Fed to go the 25 basis points. It's 3.31% annualized, but you can't take the chance that jumps up again, because when you look at these diffusion indexes, you get the very real feeling that it is possible that wage inflation could show up again. 57.4 up to 60.2. Remember, these are diffusion indexes. Anything over 50 is expansion. So for total private, you have 250 industries of whether they're going to be adding to their employment. 57.4 to 60.2, which means more are going to. For manufacturing, covering 72 industries, 47.9, which was in contraction, up to 56.3, which is in expansion. So there is plans to add to employment. And if there's, you're sitting at 3.5% unemployment, and if there's plans to add to employment, it is possible that, we could get another acceleration in wages. And if we could get another acceleration in wages, why not go another 25? I mean, the job market is strong. The diffusion indexes are pointing upwards on these. Why not? I mean, if you get to this point, I don't know that you would think that would be much of a deal going 25. And if you go 25, you also have the capital market, which has also cut 50 basis points. You could say, capital market, it's not transmitting to the capital market even if we go another 25. And if we go another 25, it's really just helping the money market funds and customer deposits that are running into money market funds. It's just helping them. So where's the harm in going 20? Where's the harm in going 50? All right, let's look at ISM manufacturing and ISM non-manufacturing or services. We have our direction here and the rate of change and the trend in months. Manufacturing PMI 46.3 versus 47.7. It is contracting at a faster rate, and it's been 5 months now. New orders contracting faster, 7 months, negative 2.7. Production contracting, but at a slower rate, but still contracting, been contracting for 4 months. Employment contracting at a faster rate. And if we look at the jobs report and you look at goods producing sectors, this is ISM manufacturing, so it would make sense. You're not going to manufacture a service, you're manufacturing a good. Goods producing had job losses. So this is consistent. Contracting faster, been 2 months. Supplier deliveries are coming in faster, meaning supply chains are improving. Inventories, 47.5 versus 50.1, contracting from growing. Customer inventories, 48.9 versus 46.9. Customer inventories are too low, but they're dropping at a slower rate. 78 months. 78 months. That's crazy. Prices. This is probably the good point in the PMI. It is leading to price, lower. Okay, I was saying lower price. Contracting prices, 49.2 versus 51.3, decreasing from increasing. The first month it's gone into decreasing from increasing. The rest here is not that important. Overall economy is contracting faster, been 4 months. The manufacturing sector contracting faster, been 5 months. Let's go to services. And we have the direction and rate of change here. Services PMI. This was a surprise, from 55.1 down to 51.2. That's a huge drop. Direction is still growing, anything over 50 is growing at a slower rate. Been 3 months that this trend has been in place. Business activity or production still growing at a slower rate, being 34 months. New orders growing at a slower rate, 3 months. Employment still growing here at a slower rate for 2 months. And again, if we look at that, the jobs report, where jobs came from, it came from the services sector. Prices, 59.5 down from 65.6, minus 6.1. That is a big drop. Anything over 50 still increasing. So prices are still increasing, but at a slower rate. 70 months on this trend. Let's go right down to bottom here. The overall economy is growing at a slower rate. Services sector growing at a slower rate. So prices are positive in both, but activity is coming in negative in both. Well, we do have to talk about energy. Your top chart up here is CL. The candlesticks here, the price chart. It's a 3-month price chart. On the bottom, we have RB. Overlaid on that, I put the term structure, the futures term structure for both CL and RB. And on the side here from the EIA, we have inventory for CL and RB, for gasoline and for U.S. crude. So you see the effect of the OPEC cut. You simply had a gap up to start the week on Monday, Tuesday, Wednesday, Thursday. And there's the gap up here on RB. And it seems to be, stuck at just a little over $80 over the past 3 months. It's tried a couple of times to break $80. Same with gasoline. You've got a triple top going on here. If we look at the shape of the futures curve, the term structure, May, June, July on oil, 80.46, 80.63, 80.36, sort of flat. And then July to August, drops 1.05, July to September 1.58, July to October 2.42. Whereas you have immediate backwardation in the RB and gasoline. I still call it RBOB, even though its ticker is RB. May to June 1.87, May to July 4.05, May to August 6.2, May to September 8.34, which is these contracts up here. You'll notice that the gasoline futures curve has oscillations in it. The higher dots here represent months, April to September. This is October to March, April through September, October to March, April through September. April through September is summer gas, October through March, winter gas. There is more demand for driving in the summer season, so you get this kind of curve in this product, but oil is an input, not an output, so it has a smoother curve. Looking at inventories, if we draw a line somewhere here in the middle of the 5-year range, its inventories are above the 5-year range. They're within the 5-year range for this time of year, but above the midpoint, but dropping towards it. Whereas gasoline is well below the 5-year range for this time of year. Suggesting a tighter market for gasoline than for oil stocks. So we would expect a steeper curve in backwardation if you have a tighter gasoline market, which this is showing that we do. If we look at the price of Brent is sitting around $84 right now. WTI sitting just a little above $80. So what is going on with oil? Where is it going to go? I've heard, well, we're going back to $100. OPEC Plus doesn't want it to drop below 80. And when we say they don't want it to drop below 80, it's the benchmark Brent that they're looking at, not WTI. So they don't want that to drop below 80. At least that's, listening to all the energy analysts out there, which they know a lot more than me about it. I'll take their word for it. You say they don't want it to drop below 80. You must have some reason for that number. And I guess, think about it. You get used to a certain type of margin. You get used to a certain type of cash flow. It's hard to give it up when you've had it good. You try to keep it for as long as you can. And if that means more aggressive management of supply, that's what you're going to do. So I'm sure they're going to do it for some time until the economics of the industry say they can't, until there's just too much oil hitting the market and not enough demand. then what are you going to do? But for now, I think they're going to try to keep these markets as tight as they can. They got hooked on the cash flow, and they don't want to give it up. I mean, you can't blame them, right? 80 to 100 on oil. This has the real potential to find its way back into inflation. So if we begin to think that OPEC is going to continue to cut supply if they see the price drop, then those energy prices will be priced into things. And GDP is energy intensive. All over the world, GDP is energy intensive. It's more energy intensive in China than it is in North America. Per dollar of GDP, it's more energy intensive in China. Well, that will get built into expectations if we think OPEC Plus is credible. Much like inflation expectations get built into things if we think a central bank is credible. So that may get built into inflation expectations. So there may be an aftershock of this that may not show up in the CPI report this month, but may show up next month after the Fed meeting. So there could be some thinking in the meeting that why take the chance? Why not just go 25 now? Because what if it does pop next month? What if it does, these higher energy prices do get built in to expectations and prices do go higher? So why not go the 25? You almost think that sure, it'll be 25 or the probability of 25 is probably higher than what the market is thinking it is if you reason this out. But it doesn't seem to be willing to go much higher than that because, of course, if we have a recession on the horizon, nothing will destroy demand for energy like a recession, which means cut supply all you want. You're not going to avoid the economic reality of dropping demand. So where this is going to go, I don't know. But it has been a good support to the energy stocks, and Oxy had a nice jump on the price. I had sold puts on Oxy. I'll continue to sell puts on Oxy as long as Warren Buffett continues to like it. I'll continue to sell puts on that. But this has the real potential to find its way into inflation, or I think at the very least to slow down the moderation of inflation. So if we think, well, inflation was going to come down like this, we probably have to now think, well, maybe it'll come down like this. So higher for longer, or maybe 2 more rate hikes, not just 1. If this didn't happen here, I think that the probabilities for a rate hike in May probably would have leaned more towards the 0 than the 25. Okay, let's get to the most interesting screen, SPY. And earnings, 2023 estimated earnings. Here is current. I just took a snapshot of the whole spreadsheet here because we're going to use quite a bit of this. 217.78. We didn't have the number last week. I couldn't find the spreadsheet, so I was using 219 and change. And last week was 213.38. So it seems to have dropped consistently every single week. 217.78. The closing SPX was 41.05. We can use the close here because we weren't open Friday. If we were open Friday, I would have to use Friday's close because this spreadsheet always uses the Friday morning or the Thursday close. That's a multiple of 18.85, which I have right there in the middle of the screen, pushing 19 times earnings. This market wants to pay 19 times earnings on higher energy prices, and both PMIs for manufacturing and non-manufacturing dropping for the week. Clearly, with earnings dropping and the economy slowing, the market must be worth more than it was the week before. I think that these earnings are going to have to come down considerably. And let's just look at the financial sector. Financial sector in 2021 reported earnings of 59.26. In 2022, earnings of 33.89. That was the year of the central bank tightening, so it became a tough environment for banks. 33.89. 2023 estimate is 40.66, a 20% increase in earnings over 2022. That the forecast is for a 20% increase in earnings. I'm going to say it again, a 20% increase in earnings over 2022. I have loan loss provisions in here. I think that is the big wild card. I think that that this 4066 for financials is way too high. It's going to have to come down. We're going to get some kind of hint this week. I don't know if we'll get the best look, but we have financials reporting this week. BlackRock, First Republic, Citigroup, JP Morgan, Wells Fargo, and PNC Financial are coming in this week. Let's listen to what they have to say about loan loss provisions. Well, I think you'll get that from Citigroup, JP Morgan, and Wells Fargo. IVP, 13-week is at 11%, still really low, but up from 3%. If we are thinking about an equilibrium price, if we want to place an equilibrium price on SPX, which I find a good exercise to do, because for 2024, the market seems to be putting an equilibrium multiple on it. If we look at 2024 PE, 16.79 on the 2024. This is 2024 expected earnings here. The current amount 244.52, and given the current price of where we are, that is a multiple of 16.79. So if we take a 16.6 multiple, which is a long-term average for a forward multiple, multiply that by 244.52, we get to 40.5903. And since we're using 2024 earnings, that would be a December 31st SPX price, because you're using the forward earnings. This is the price today, and if this is 2024, this must be December 31st. So we can think of a year-end price by using 2024 forward earnings with a multiple of 16.6. We get to 40.59. We're at 41.05 now. So that's assuming that we'll drop a bit by the end of the year, that we'll end the year slightly below where we are now. That says nothing about the pathway, it just says the ending amount. Well, what if we moved forward instead of using 2024? Because I find a lot of this stuff here is, well, there's a healthy dose of fantasy in there. Nearer term forecasts tend to be more precise, even though they are still just guesses, they tend to be more precise. So if we take 16.6 times the 217.78, we get to 36.15. And considering an expected return, a long-term equity return on markets of about 11%, the dividend is about 1.8% of that, which means 9.2% is a growth factor. So let's increase this by 9.2% for the remaining 267 days of the year. We get to 38.58 as a year-end price target. This is 40.59. So you have a year-end range, 38.60 to 40.60. I just rounded this up to 60 and rounded that up to 60. 38.60 to 40.60, a 200-point range for year-end that we could end up somewhere within there. I would put more weight closer to the 38.60 than the 40.60, because you're using near-term earnings forecasts instead of forecasts that don't even begin until Q1 of 2024. And we are at 41.05, so there is some downside on that. If you think that financials can book a 20% gain in their earnings per share year over year, that would be saying that their loan loss provisions are probably not going to increase that much. I don't really know, especially when you get to anything they have with commercial real estate. Something is going to have to give there. They may also take this opportunity to add to their loan loss provisions because they have the cover of the economy, that they could say, well, we're doing this for conservative reasons. They do have cover to get that done. I sold 10 more calls on Friday morning after the report, when the futures started to show strength. The 4170 calls I sold for 124.50, 68 days to expiration. It's the June 16th that has the September underlying. I got 124.50 at 4170. So the SPX is sitting at 4105. If you take the 4170 strike price and add the 124.50, I'm at 42.94, which is 190 points higher than where the SPX is right now. So by June 16th, the SPX would have to be above 4,300, for me to lose anything. Anything below 42.94, I'm going to make something on. Anything below 41.70, I get the whole amount. Anything between 41.70 and 490 and 42.94, I simply get assigned an ES position, so I'd be short September ES. My theta on this, by the way, is 43.45 per contract. Since I sold 10 of these, it's 434.50 per day on theta. So we'll see what happens with that. But after seeing what the forecast for earnings were, after doing the calculation on this, because I had this on Thursday night, after doing the calculation for this, I thought, okay, well, I just can't see this happening, this 20%. And if we think about where the drop in earnings is coming from, we have Q1 all the way to Q4 over here. Change negative 0.26, negative 0.2, negative 0.3, negative 0.35. So it's not as if it's all just coming off the first quarter. It's coming off all of the quarters, although we are showing growth through the quarters 50 to 53 to 56 to 57. I am, in the end, highly skeptical of the 40-66, a 20% increase in financials. I think loan loss provisions will be higher, and I think guidance from other companies will be lower. I expect this 217.78 to continue to drop. Now I want you to think about 210, and as it's dropping from 270 to 210, are you going to start going from 19 to 20 times? You'd have to get to 20 times. You'd have to increase to 20 times earnings to get to 4,200. That if you drop that to a more reasonable 17 times, we'll multiply 17 times 210, you get to 35.70, which is below the price here, which is basically you're just revisiting the lows that you had in October. Let's have a look at the earnings calendar. Although we've seen what we have here for financials, we'll have a look at that, and then we'll have a look at the economic calendar next week. Okay, so in the week coming up, 12 issues are reporting. It tells you what day and what company it is. Nothing really exciting starts till Thursday. You may find some of the other things exciting, but I think the big story here is going to be the financials. You have BlackRock, First Republic, and Progressive, and then Friday is the main event. Remember, Wednesday is a big risk event day on its own. You've got CPI and the Fed minutes, followed by Thursday with PPI, followed by Friday morning with retail sales and reports from Citigroup, JP Morgan, and Wells Fargo. You have PNC Financial in there as well. Heading into early next week, Monday and Tuesday, Charles Schwab, M&T, State Street, Bank of America, Bank of New York, Goldman Sachs. So financials right out of the gate. Economically speaking, Wednesday's a big day. Financially speaking, at least from an earnings perspective, when I say financially speaking, Friday is the big day. Let's look at the economic calendar to see what else we have. Okay, I think I've pretty much highlighted everything. Monday, you have Williams speaking. Tuesday, you have Harker and Kashkari. Other than that, not too much going on. Same with the earnings front, nothing too much going on. Once you get into Wednesday, there is your CPI at 8:30. There's your Bank of Canada interest rate decision at 10. Get down to 11. There's your Bank of Canada press conference. Head over to 2 o'clock. There are your minutes. I'll try to have a video out Wednesday night reviewing the minutes. Going into Thursday, you have PPI, and then, of course, your continuing jobless claims, your initial jobless claims. There is Tiff Macklem at 9 o'clock giving a speech. Next day, Friday, retail sales. And remember, Citigroup, Wells Fargo, JP Morgan. Listen to the JP Morgan call. You have retail sales. The call, I think, starts at 9:30. Is it 9:30 or 8:30? I think it's 9:30. It starts. Anyways, it starts at a time that's inconvenient. So whatever inconvenient time it is for you. There's retail sales. And then 10 o'clock, you have Michigan consumer sentiment. I don't know that that's going to matter too much. I think the banks are going to dominate the conversation that morning and throughout the day, and I think the tone of the market is going to be set back here with CPI. I think the tone is going to be set there. I think when you get the minutes, it is going to show that there were some members who wanted to pause. and I think that is probably going to be bullish. So if you have a nice soft CPI report, and you get those minutes out, and we see that there were some members who wanted to pause, I think that is going to be bullish, and that is the week ahead.